Gold is in the process of breaking out, and there's a tremendous amount of momentum behind us. I think the dam just broke. Gold can go probably 6,000, maybe 7,000. If these countries start doing that, I'm a buyer of gold. Silver is in the middle of a perfect storm. This is a GameStop moment for the price of silver. What's going on with the difference between paper silver and physical silver is identical to what happened with GameStop, and that's why you see these parabolic moves in the chart. There is no way, no how that gold or Bitcoin or anything else like that can replace the US dollar. There's simply nowhere to park capital on a short-term basis that's as high quality. The whole United States economy is changing. It's changing for the better, and it's changing historically fast. I've never been more bullish on stocks than I am right now, particularly tech stock, particularly this AI trade.
This is The Real Story with Michelle Makori.
Hello, I'm Michelle Makori. This is The Real Story. Thank you for watching. Gold has just crossed a historic threshold. Prices have broken through $5,000 an ounce and have surged past $5,111 an ounce, putting the metal up more than 15% year to date. And this is after a staggering 64% gain in 2025. It's the strongest annual performance for gold since the late 1970s. And the very institutions that once dismissed gold as a relic are now racing to rewrite their forecasts. SocGen now sees gold reaching 6,000 by year-end, calling that forecast conservative. Morgan Stanley's bull case target sits near 5,700. Goldman Sachs just raised its year-end gold target to 5,400 an ounce. So what was once viewed as an insurance trade is increasingly being treated as a core asset with strong upside. And silver has been moving even faster. Spot silver has surged to an all-time high above $117 an ounce, decisively clearing that triple-digit level. Now, historically, explosive moves in gold and silver have coincided with financial stress, currency debasement, systemic risk. Gold and silver rising are not usually a positive sign for economic fundamentals and a booming equity market. But my next guest says that he has never been more bullish. In fact, he believes that the United States is entering a multi-decade cycle of growth, productivity, and capital dominance, and a booming equity market. He says that the strength in the US economy is all driven by artificial intelligence, energy expansion, manufacturing reshoring, and deep liquid capital markets. He says the outlook is the most bullish in decades and that in this environment, stocks and gold can all rise simultaneously. And joining me now is Mike Lee, founder of Mike Lee Strategy, an investment management firm and financial planning firm for high net worth and ultra high net worth individuals. Mike, very good to have you with us. Thanks for joining us.
Thanks for having me, Michelle.
All right, Mike, let us start off with gold soaring past $5,000, breaching that milestone. Now, you've always been very bullish on gold, I will say that. And when you and I spoke in 2024, you were extremely bullish. Gold at the time was at around 2,200. And then you told me that you expected gold to hit $5,000, but by 2028. Now, at the time, we didn't have that 3,000 milestone breach, nor that 4,000 milestone breach. So it's really quite dramatic that we've had such a move up. So you were very bullish, but even not bullish enough, seeing how gold has been performing. So now that we have gold in 2026, starting off the year with a bang at $5,000, what does that tell you?
Look, so gold is in the process of breaking out, and there's a tremendous amount of momentum behind us. And I'd say, look, pre-COVID, the fiscal situation in this country was not that good. Post-COVID, it's just a total and complete destruction, and you're still running budgets from Congress for the United States that are at COVID spending levels, like it seems like a $2 trillion structural deficit. And the Biden administration and now the Trump administration, to some degree, has weaponized the use of the US dollar. And there's a massive divide throughout the world about where you should be putting your bank reserves, and do I want the U.S. To be able to control my money? And so all of these factors led up to the dollar or to gold just absolutely breaking out. It's been a 10% position in my equity portfolio via ETFs since the beginning of 2023. It's worked out extraordinarily well. Um, I think once we get up closer to 6,000, I'll start reducing that position. But look, I don't know why we all of a sudden just hit the gas with gold. I knew we were going to get here. I don't know why it happened so fast right away. And so yet here we are.
Right. And, many, of course, point out that this is a sign of a major structural break, which we'll get into. But to your point, central bank demand has been tremendous. Reserve reallocation. Emerging market central banks have been buying aggressively. They're reducing dollar dependency, responding to, as you mentioned, the sanctions risk and the weaponization of the dollar, which was particularly accelerated under the Biden administration with kicking Russia off the SWIFT system. So obviously there's this move by central banks to diversify away from politically vulnerable assets. Currency debasement, fiscal dominance, as you just discussed, we have exploding debt levels, over $38 trillion in debt, permanent deficits. And then, of course, you have that big reality that fiat currencies in general, not just the dollar, are being devalued over time. So, gold, many would say, is not just a hedge against inflation, but it's also now a hedge against long-term currency debasement, the debasement and devaluation trade, sovereign balance sheet deterioration, and of course, this global change of de-dollarization with central banks now owning more gold than they do U.S. treasuries or U.S. dollar denominated assets. And then you throw in the supply side, because people tend to forget about the supply side of gold. And the reality is that mining capex has been constrained. The project timelines take forever. We had all of this ESG curtailing permitting, so lots of hurdles there. There's no fast supply elasticity with gold. As we know, there's limited supply of gold, but even to get the engines going to get more gold takes a lot of time. So is that broadly how you see the forces lining up behind this move? And which one of those do you think is the most significant driver here? Is it continued de-dollarization?
I think the dam just broke, and you live in an age where computer algorithmic trading just buys so much on momentum. And so gold, I think right now is a beneficiary of that momentum, because everything that you've said has been true for, basically since 2008, 2009.
Well, not the central bank buying. To correct you there, not the central bank buying.
But the reasons for the central bank buying. Yeah, but
and not the idea that the Fed is not able to control the situation. We still had a lot of, perhaps misplaced, but we still had faith in the Fed in 2008. We didn't have, this level of fiscal dominance either. I mean, granted, these have always been issues, but I mean, the central bank buying, that's been super significant, and hence my question, if de-dollarization is the dominant trend here, pushing this rally.
Sorry, I should have been more clear. In the wake of 2008 and the quantitative easing that followed, right, which also brought the birth of Bitcoin, right? And so I think this massive price move we've seen over the last 90 days, that is a lot of technical momentum based, okay? And so you can talk about the de-dollarization, but I'll just caution people out there, like gold can go probably 6,000, maybe 7,000. You got to remember though, there are long dead periods of gold. So circa 2011 to 2023, the asset did absolutely nothing while a lot of other things went absolutely bonkers. But look, there's nowhere else to park your excess reserves. So until there's a currency that can replace the US dollar, the US dollar will be the reserve currency. That doesn't mean it's not going to lose value. That doesn't mean gold is not a good investment. It just means the dollar is not going anywhere for a very long time. You need some form of currency where you can park trillions of dollars of assets on a daily basis that's going to pay you interest. And so, yes, the dollar definitely is losing value over time, But to be able to buy tens of billions of dollars of gold and move in and out of it on a daily basis, it's not reasonable. It's not realistic. And all these European pension funds talking about dumping their treasuries, like, good luck. Where are you going to go with the money? Like, the dollar is the reserve currency very much for logistical reasons as much as any other reason. There's simply nowhere to park capital on a short-term basis that's as high a quality, right? Because if this is your access, so in global trade, it's not a zero-sum game. So if I buy widgets from you and you buy farm product from me, it's almost never a zero-sum game. Someone's going to end up with some extra. So if we're dealing in dollars and that extra can be parked in T-bills, paying you 3 or 4%, well, yes, the dollar can move, but if we're dealing constantly in dollars all across the world for these sorts of things, um, it's really hard to replace it. When you use Chinese yuan, you use euro, no chance. Like, these other bond markets can't handle that the way that the U.S. bond market can. So that presents good and bad things for gold. Um, Good in that the need for fiscal discipline in the United States Congress is not really there, because until something can replace it, you're not going to see anyone in Washington get their act together, which means we're going to see this decline of purchasing power over time. But the chance of, like, from a logistical standpoint, there is no way, no how that gold or Bitcoin or anything else like that can replace the US dollar. And, like, you're starting to see things that being done in USDT, um, the sorry,
Mhm.
the cryptocurrency that tracks treasuries, um, that has emerged
Stablecoin.
as a massive buyer of T-bills. So, look, I think we've got some more moves to go in gold, but once it gets to 6,000, out of my 15% equity position, I'll probably take that to 7.5, and then 5, and then 2.5, and I'll always own some. But as we go much higher, you can get stuck in a situation where it's dead money for a very long time.
Well, my point on the dollar is not so much that the dollar, disappears. To your point, it's very much needed as a medium of exchange, as a globally recognized medium of exchange and a short-term facilitator. But I think the bigger trend is this idea of store of value and a neutral reserve asset. And that, to me, is why maybe the fundamentals are very different from previous rallies. We have Goldman Sachs, for one, expecting central banks to purchase roughly 60 tons of gold per month this year. Poland alone has just approved plans to buy another 150 tons, more than the total reserves of some major economies. And then on the de-dollarization front, again, it's not that they're not going to use dollars, but there is this move to reduce exposure to U.S. treasuries. I'll give you India as an example. India's holdings of long-term U.S. government debt have fallen to a 5-year low, 26% decline from their 2023 peak, and that's according to U.S. government data released. So, we have this trend. And my point is that as we're having this central bank trend, and we're having the debasement and the reduction of purchasing power. I'm not saying the dollar is going away anytime soon, and that's not anything I'm rooting for, certainly. But why would the rally stop when this seems to be a big global macro structural change? Like, why would it stop at 6,000?
So why did it stop in 2011? Right, as we monetized our
Well,
debt for the first time in U.S. history.
no central bank
Yeah,
buying in 2011.
maybe, but there are plenty of other people out there buying, um, and maybe central banks didn't want to at that point, but it was clear we were going to have massive deficits in the U.S. and we were entering a stage of quantitative easing to drive down long-term interest rates. So maybe it is the central bank buying. I like you've had these long-term trends in gold where it's like 250% of the previous cycle high. That's maybe we extend it here, but I can't see gold just being on this eternal march higher, a la the S&P 500. Like, when an asset moves this much in value in this short period of time, you generally don't continue moving that way at the same rate of change when it's a physical commodity, right? And it's a physical asset, whether it be real estate, gold, oil, soybeans. There's generally a comeback down to earth. movement in it, and because it's what's really fundamentally different between now and a year ago, right? Everything that you're talking about, yes, there's central banks are buying it, but what about the value of gold? Is that fundamentally different
Well, it's
than a
it's
year
that
ago?
same it's that same trend accelerating. And a year ago, we did see gold break 3,000, break 4,000, decisively hit 5,000. And just to play devil's advocate here, back in 2011, gold was largely driven by Western investors and ETFs. And again, now it's central banks that do not trust the US. They do not trust the dollar. Back in 2011, the Fed still had credibility. It could tighten policy without breaking the system. Today, debt levels are dramatically higher. So, the policy regime today just potentially
I'll,
changes the
I'll,
durability of this gold
I'll,
cycle.
I'll 100% push back on the Fed credibility in 2011, right? Like it's the 10-year hit 4% in 2010 when Obama passed Obamacare and all of that spending. And they couldn't have that in Washington. So they
I'm not
wanted
saying
to,
they should have had Fed credibility back then. I'm saying
yeah,
I
but
still think that the perception was a little bit more
maybe I
favorable.
just, I like, the value of a commodity doesn't double in a short period of time and stay that way in
Okay.
perpetuity,
So,
right?
okay, so you're seeing 6,000 at this by when? And you're
Look.
calling that as,
Just
as a top.
based on the momentum we see now, that could be the summer, that could be the end of the year, it could be earlier. But that's when I'm going to start taking things off the
Okay.
table because I started buying the ETFs around 1800. So I'm like I'm going to be more than a triple, more than a three bagger there in that point, and that's when I personally am going to start reducing. And then, like from a personal investment standpoint, I have physical gold. I'm going to continue owning physical gold for the rest of my existence. But from a portfolio management standpoint, if you're looking and you're benchmarking your returns to anything else, once something like this triples
Yeah.
over that short of period of time, it doesn't hurt to take some of those gains off the table
Right.
because it's likely to underperform going forward.
I hear that as a portfolio strategy. Let me ask you about this interesting development that we have with regards to Germany wanting its physical gold back, and what you think about this means as a larger trend, because there are now growing calls for Germany to repatriate a large portion of its gold reserves that are currently stored in New York. It's more than 1,200 tons of gold, so a huge amount there. And apparently the Bundesbank is openly saying that given the current geopolitical environment and the US political unpredictability, that it is too strategically risky to leave that much sovereign gold under US jurisdiction. Now, this hasn't happened yet. Do you see this happening? Do you see this as an isolated debate inside Germany? Do you see this potentially as an early stage of a broader trend where countries start pulling their gold reserves out of the US and back home?
So if these countries start doing that, I'm a buyer of gold because, look, why? And I'm wrong, and gold's going much higher because, like, why do you think Elon and Trump never let you see what's inside of Fort Knox?
There are very different theories on that one. Firstly, there is a bill to audit that that's apparently still being looked at. Now, some would say that the gold isn't there. That's why they don't want you to see what's
Look,
going on.
it is,
Others would say that
so
there is
why
more gold there
so,
than we expect.
yeah, if there was more, they'd hide the extra, right? Like it's not that hard. It's not there. Like rich people in this country stole it, and I'd imagine that's what's going to happen in Europe. And like they're gonna like it's in New York, so it's verifiable, right? Like, and it depends
So
how they
you're
put the
not
backstop.
concerned. You're not concerned about European
Well,
countries
I'd
and
say
others
it'd be
asking for
wildly
their gold
bullish if
back.
they did, because that means their broker and like the demand for gold is bigger than I thought. Because when it's in New York, it's third party verifiable. Who can go verify for Knox? Okay, I guess Trump can't and Elon couldn't, right? And why not? Why not?
Well,
Why not just walk around with the cell phone camera or a GoPro and just show us, right?
well,
If it's all there.
I'm sure we'd want a slightly more sophisticated way than a live stream walkthrough of Fort Knox. Of course, have to test that the gold bars are really gold and whatnot, but it would make for very good viewing, I will say that. And, it could still happen. That bill is still out there, but I hear the point that you're making there. Before I get into the general macro outlook, I do want to get your thoughts on silver here. Because again, silver has also surged to multi-year highs. We finally have that triple-digit silver. I mean, this was a milestone that people in the silver market would see as this great, unobtainable, shining beacon on the hill to strive for. And here we are. We've reached triple-digit silver, and we have blown right past it as quickly as we've reached it. How do you see silver in this environment?
So silver's a tough one. I mean, look, I bought the ETF when the physical crossed. I think it broke through 34. And then I bought the ETF, sold a bunch in the 50s, and now maybe I sold a little too much. But I thought when it broke through 34, thinking it would cross to 40. And that was on a pretty significant amount of strength. I think silver is in the middle of a perfect storm. You have people who are short there. There are all sorts of people that want to take physical delivery and you can't locate it. This is a GameStop moment, I think, for the price of silver. I think we could go, you could get another 20 to 50 bucks on it, but kind of when something moves parabolic like this, it generally reverts to where kind of it should be on a fundamental basis. And like, I don't know, maybe the case for that is 75 bucks, maybe the case is 100, maybe the case is back down to 50. I'm happy that I was able to partake in that trade for my clients. But there's definitely a new normal for silver with the demand and practical use of it, given the industrial build out and applications for it. But I am skeptical of silver's long-term viability and this gold-silver relationship. We talked about that earlier. It never seems to work since I've been tracking it for 20 years. So I don't know why it's all of a sudden going to start working and be real now. And maybe that was just an anomaly for the last decade or two that I've been watching it, and it was the long time to look at it, and I've capitulated. But I just, again, what I was touching on with gold is the value of something that's a commodity. It's one thing if you're a company and you invent a new product, or you like NVIDIA and you create something that's going to change the world. Like silver didn't change the world. It just didn't, like the movement of it, and for the asset to triple in a very short period of time. Like what, like again, it's not like oil where all of a sudden, there's a big war in the Middle East and you've cut off everyone's supply. So I am like, I definitely think there's some more momentum behind it, but if you bought it in the 30s and 40s, you'd be smart to start selling pieces of it. Right. And that's kind of my strategy, is you sell pieces on the way up.
Well, let me ask you this. I mean, if silver is both a monetary and industrial element, and we are seeing tremendous industrial demand, I mean, I guess that's the factor that's different from previous silver rallies, is that silver is used from everything to AI microchips, to cell phones, to solar panels, to electric cars. There has been a really robust demand for silver on the industrial side. And you could say that the price has been artificially suppressed for a very, very long time because of the demand from the military-industrial complex, that there's been an incentive to keep silver prices down. And as the military budget is growing, I believe it's increased to $1.5 trillion, as the defense budget rather is growing, as the geopolitical war drums are beating, there's more and more demand for silver in the defense sector as well as the purely industrial sector. And you have that whole debasement and devaluation trend. And you have silver as a monetary asset. And then you bring in this idea that perhaps is finally a crack in the market, that there is a lack of physical silver supply, and that the demand is now exceeding the supply, and that we're seeing that exposure, that the paper silver doesn't really have the physical silver behind it. I mean, I think that is one of those are the core principles driving this current silver rally. Now, I get the point of taking some money off the table. That certainly makes sense. But would you still see this as a trade or a core holding given all of those macro fundamentals?
Yeah. So the only physical commodity I would believe is a core holding is gold. I just don't believe that I have any other precious metals or oil or anything else. Um, so I think silver's a trading vehicle, and I think it probably has some more legs. And it's this paper physical. Once the word gets out that there's an imbalance, well, then all of a sudden a brand new set of physical buyers just happen to emerge. Right? It's I don't know if I call it a run on the bank, but it's the same concept. And but like once that hysteria and the paper and physical market level out, what does the price do then? Does it revert to 100, or have we gone to 250 and it reverts to 150? I definitely think it's not going to be a $20, $30 asset when all the dust settles. Um, but that doesn't mean like after this run, um, like I don't think it holds the long-term value the way gold does. And that's just 20 years of observation, not really there's no there's no it's like I said, that gold silver ratio. And so my 20-year observation period of this gold silver ratio being utter nonsense may just be the anomaly that I've sat here and watched, right? It's like owning Microsoft from 2001 to 2015. You just give up and then the thing goes up 10x, right? Like, so maybe I very well could be in that scenario, but I do not view silver for my clients or myself as a core long-term holding. However, it has been a spectacular trade.
So let's get back to those trade levels. At what point in your thesis are you selling silver? Do you have a bottom that you think even with a pullback, silver would settle at?
So I don't know. I don't know where this is going to end up because I believe there's a new normal, right? Kind of like when Silicon Valley Bank failed and Bitcoin rallied, right? That was the first time that Bitcoin rallied on the Silicon Valley Bank on a flight to quality, and it wasn't just a risk asset like a levered Nasdaq play. Silver has fundamentally changed, and like the demand for EVs that you were talking about, these AI data centers, the chips, everything that's going to have to build out the demand. The physical demand for silver is new, and so I don't know where that price is. I am shocked that it's at 110. And I've been talking to people about like when it gets above 90, sell. Um, you know, Unfortunately, and nobody listened to me. Uh, so, like maybe it's $75, maybe it's $50, maybe we double from here, and this is the new normal. But like, I don't. When there are these supply demand imbalances, right, with the physical and the derivative, you saw this is exactly what happened with GameStop, and that's why GameStop went to $400, right? You're starting to
Can
see
you
mass.
compare? Can you compare a meme stock driven by viewers on Reddit to an asset that's been around for thousands of years, that's been money for millennia, that has now real industrial demand? Can we really compare that to
Yeah, yes,
a meme
yes.
stock like GameStop? Come on.
Well, look, it's identical. What happened because what the redditors were doing is they were buying call options. They were buying call options, and if you're an options market maker, you end up with naked shorts. And so when you break through those call strike prices and they go to cover the short, and there's not enough physical stock because the short is X number of times the float of the stock, right? You end up with a physical versus paper imbalance. And so it's not the underlying investment, it's what's driving immediate short-term price movements is literally identical to what happened to GameStop, right? So like I'm not trying to say like investing in GameStop is the same as is buying silver, but what's going on with the difference between the future and paper silver and physical silver is identical to what happened with GameStop. And that's why you see these parabolic moves in the chart.
I will say that there's obviously some trading momentum, some retail enthusiasm, that big disconnect between the physical and the paper, some manipulation of the markets that sort of come to light. But I mean, I still think like fundamentally, you can't compare even though
No,
you
no,
do
no, no,
have
no, no, no.
that dynamic, which is an accurate dynamic and is probably tremendously propelling and may, have a
but,
pullback
but,
at some point.
yeah, but you have to ask yourself, what is so fundamentally different for an asset price to triple in 3 months? Right. And so, like there are businesses where their future outlook changes that much. Right. And so the things that you're saying about silver, maybe there's some accelerated buying. And then maybe there were shorts and like you broke the back of the people trying to keep the price down. And now we've reset. But it's what's going on with the shortage of physical supply versus the paper is the exact same thing that happened with GameStop. Is that you had an options market that needed to locate actual physical shares and short sellers, massive short sellers out there that needed to locate those shares as well, that just didn't exist. So like when you're short 5 times the float, like you're just going to keep buying and buying and buying and buying. And so the same thing will happen with the paper. They'll just keep need to buying, they're just going to keep looking for the physical, the physical, the physical. And at some point it settles out and it normally kind of reverts to where it was. And so before silver went parabolic, I don't know, was that $90? Was that $90 an ounce before we really, really went parabolic, or was it in the 80s?
It was, I believe it started off the year in the 40s.
Oh, no, in December, we were a little bit higher.
Oh, no,
It,
no, no.
it,
I mean 2025 in the 40s is what I mean.
Oh yeah, no. So, but that was a clean kind of upward moving chart. And when you see the parabolic hockey stick up, like I think before it really, really went parabolic, like we were in the 70s and 80s, and we'll see what happens over the next few months. Maybe we end up back there, but I think I'm agreeing with you that there's a new normal for silver. I don't know where that home is, and if it goes up another 30 or $40 from here, and you own it in the 40s, right? Or you own it in the 30s, like I do, like you should be taking some profits because there's something going on there. Like if you own GameStop at $5, okay, and it goes to 400, sell some, right? It's not.
Yeah,
Um,
that is sound financial advice for sure. And again, Mike, I love you. I just like to play devil's advocate
no, no
and push
problem.
back on some of your theories here. Again, we are seeing this silver move to the east as well, where China and India, they're hoarding up on it. It's a different sort of mentality again, and many would say that it's also part of this anti-dollar trade, this moving away from the dollar as an asset, and that there is also this angle, not only for industrial use, but also as a monetary metal. And I want to shift a focus now, and it's actually linked because what isn't helping the dollar in general is this dysfunction in Washington. Now, again, I do think that the Trump administration is taking some very, very important and bold moves to sort things out on the big picture, on the world stage, in the domestic economy. But until that works out, if that works out, there is a lot of pushback and that bifurcation of the global monetary system that we're seeing, which is a reality. But I want to get your thoughts on what we could be heading for and what impact that is going to have on gold, silver, and the markets. And that is a partial shutdown because Senate Democrats are saying that they're going to oppose a funding package that includes appropriations for the Department of Homeland Security. Now, this is tremendous pushback against the Trump administration efforts to deport illegal immigrants. As we know, there have been some violent confrontations with ICE and protesters that have had some tragic results. And if this happens, then, Mike, large portions of the government will shut down on Friday unless the Senate approves the funding package before then. And do you firstly see this shutdown happening? And then what impact would that shutdown have?
Yeah, so I haven't checked the poly markets since I saw the headline, but John Fetterman said he'd come out and he'd never vote to shut down the government. Right. And so, if you have at least one Democrat, that means you can lose a few Republicans, because, you only need 50 to vote. So I think we can lose 3 Republicans. I don't know that we're going to lose any Republicans. So it depends if they can. I don't know if they can get this through reconciliation, which means they only need 51 votes to get it through reconciliation. Um, so I am, since Fetterman came out and said that, I do not believe a shutdown is on the table, because I think the left has their rallying cry, and that last shutdown. For everybody watching, the shutdowns are, if they're prolonged, historically until the last one, they've done nothing to affect the economy or the stock market because they've never lasted that long. The shutdown that we just had was devastating for risk assets. Why? The U.S. Treasury general account went from 500 billion in the beginning of September to about 1.1 trillion the first week in November. That's $600 billion that didn't go out into the banking system because the government couldn't spend money. So that's $600 billion. So if the Fed went out and bought $600 billion worth of bonds in 10 weeks, that's going to add a tremendous amount of liquidity. It's going to push a lot of risk assets higher. So with a shutdown, the dollar will get stronger. I believe the DXY went from like a 96 to a 101 in that time frame. So when there's very quick, sharp, strong strength in the US dollar, it's not good for gold. It's not good for equities. It really froze a lot of sand in the gears of almost every asset. So we want to avoid that shutdown, and we still haven't put all the pieces back together. I'm like, well, how does that affect the equity markets? Well, if you've got $150 million of stock at the end of the day, and you've only got $100 million money line, you take that extra 50 million, you go somewhere and say, hey, I'm going to enter into a repurchase agreement. I'm going to give you my $50 million worth of stocks, and you're going to give me $50 million of cash. And I agree to repurchase it from you tomorrow at a specified price. And you'll make some sort of annualized interest rate, depending on the riskiness of the assets, of anywhere between, SOFR 375 now up to 10 or 15%, again, depending on the riskiness of the assets. Well, at a certain period of time, the banks just didn't have the money. So I can't give you 50 million in repo. I can only give you 20 or 30. And if I can only, and that means you got to sell stock, and you don't sell what you want, you sell what you can. And it ends up being Bitcoin, the highest, fastest moving tech stocks. And so you kind of unwind from there. And once there becomes a little bit of selling momentum, then the algorithms get involved, which I believe they are in gold and silver right now. And they just start pushing assets around. So I really hope we avoid a shutdown. And if by the time we're watching this, we're doing this on a Monday night, and so a lot can change over the next few days. But the Democrats are threatening to shut down the government over ICE funding, which is definitely a rallying cry for them. We'll see if they follow through. If this ends up being a prolonged shutdown, this will not be good for risk assets, and you could see another 5 to 10% correction in kind of all my favorite stocks.
And we'll get to your favorite stocks very shortly. But yeah, let's hope government maintains to function. Another part that is spooking markets a little bit, and that is the Bank of Japan and the yen carry trade. Markets are very focused on that. The Bank of Japan is changing its ultra loose monetary policy. It's already raised its benchmark rate to around 0.75%. It is signaling that it will have more increases ahead. Now, just to explain to our viewers what the yen carry trade is, you borrow money in a currency with very low interest rates, the yen. You invest that money in assets with higher returns. And Japan has been that funding source for years because the Bank of Japan has kept interest rates near zero for almost 2 decades. The yen has been weak and stable enough that traders felt relatively safe holding the trade. So a hedge fund would borrow yen very cheaply, convert it into US dollars, buy US equities or treasuries or other assets, and then that profit comes from the interest rate difference. And over time, this has been a very successful niche strategy, but then it expanded to, many would say, is really a building block of global finance. The higher yielding the destination assets, the more the leverage builds up. So, there is concern that this yen carry trade could blow up, right? What are your thoughts on that? People are warning that this could crash global markets. Is that realistic? Is this risk being exaggerated? Is this risk? Where do you rate this risk?
Yeah, so it did a lot of damage last summer when I believe they raised 50 basis points, and it was very unexpected. And so if they, on a go forward basis, if they're going to have three more rate hikes this year and they're transparent and talk about it the way that the Fed has in the US, I do not believe you're in for a blow up. But like if we get another surprise intra-meeting 50 basis point rate hike from the Bank of Japan, you will see a lot of things fall apart because of all the reasons you just walked through. But I think those are temporary disruptions and become buying opportunities the same way a shutdown would. It's just not something we want to sit through, and it just takes time to rebuild these stocks up.
And again, the yen carry trade also is determined by a weaker yen. So we're seeing the yen strengthen, the dollar weaken against the yen. So that has an impact there. But there's also some talk of intervention. There's some central bank signaling possible market intervention. Investors, you don't usually intervene unless there's disorder. Do you think that the US could intervene in this trade? At the risk of preventing, this major blow up? There's some chatter about that. Is that something that you think could happen?
Look, if it's a good trade for the US a la Argentina, I definitely could see it. You got to understand, Scott Bessent was there when Soros broke the pound. And if there's an opportunity for him to help out an ally while the US profits handsomely, they're unafraid to use the US balance sheet the way that when they were running hedge fund money.
They definitely have taken a different and many would say creative and profitable approach. Let's zoom out here because your big macro outlook is very positive. You're saying that the US is becoming the dominant destination for global capital while Europe and China are weakening structurally. Talk us through that. Where do you see the US economy, big picture? Give me your macro thesis.
Yeah. So a lot of it starts with artificial intelligence. So obviously, AI is a wave of the future, right? It is the largest technology trend in our lifetimes. It is happening so much faster and so much bigger than I think people thought 6 months ago, a year ago, and then definitely 2 years ago. So if you look at the knock-on effects of artificial intelligence and then building all these data centers, is you need to provide energy for that, and you can tell the health of an economy and the health of a country by their increase in demand for energy. And the increase in demand and energy in the US has been paltry, 2 to 3% in line with our GDP growth, maybe even less than that in certain pockets over the last couple of decades. And all of the capital expenditure on energy has been in green nonsense. So we have an outdated grid. We have one that, instead of maintaining existing fossil fuel baseload capacity that can run 24/7. You've been spending money on wind farms and solar and blah, 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 blah. Like stuff that just doesn't really work and is basically a shell game for companies like Duke Energy here where I live in Florida to get tons of taxpayer money to spend it on capital investment, take a piece off the top and raise everybody bills, energy bills. That all turned on a dime, okay, with this demand for AI. And you'll see our biggest climate change cheerleader, Bill Gates, basically throw it in the trash, like a Toy Story meme with Woody, just like, I don't want to play with you anymore. And so now you have all of these interesting solutions to bring on energy. So first of all, you're looking at trillions of dollars a year with the T every single year, maybe as high as 5 trillion in a calendar year, next year or the year after, to upgrade the energy grid and build these data centers to fuel artificial intelligence. And you look at the deals like an Oklo's doing in Ohio with Meta. It's going to be 1.2 gigawatts, just short of the 1.21 needed to power the DeLorean and Back to the Future. But that's going to be a modular nuclear reactor to power their data center. And what's going to happen is you're going to see these pop up. GE Vernova to build gas turbines for data centers has got a multi-year backlog. Okay, the amount of energy that's going to come online in the US is going to be almost unprecedented. We always overbuild. So if you fast forward 5 years from now, the US is going to have the cheapest energy in the developed world. Okay, where contrast this with Europe, where they shut down their nuclear power plants, like easily the most effective way. Then like they have all these carbon taxes and nonsense and like what they're doing in Canada, where they won't drill anywhere. You contrast that. Yes, in China, they're building a bunch of coal plants. They're not going to be able to stand up mini nuclear reactors and power plants the way that the US is to power that. And then all like these are all going to have excess capacity, which will just make sense to push that out into the grid. So you're going to have this grid development. You're going to have all this energy supply development and all this data center development. And oh, yeah, the multiplier that's going to come from adding artificial intelligence to white collar America. And again, on top of the regulatory environment changing more now in the last 2 years than it ever has in the US in a good way. So the endangerment finding allowed the EPA to regulate greenhouse gases. Okay, the Obama administration did a 3-month study and boom, all of a sudden the government agency has untold power to just run havoc throughout the economy. Heritage Foundation estimated that the Biden administration alone added 3 to 400 billion dollars of regulations, environmental regulations over the 4 years that just gets sucked out of the economy for nonsense. It's going to take some time to reverse that from a dollars and cents standpoint, but we've already undone it at the EPA. Like Lee Zeldin at the EPA is doing yeoman's work. So again, you fast forward 5 years from now, we have the best regulatory environment. We have the cheapest energy in the developed world. We're the leader in robotics. We're the leader in artificial intelligence. Okay. We're already have the best capital markets in the world, and we already have the best rule of law. And like, look, as long as this dollar doesn't get stratospherically strong, okay, it's going to be really profitable to make things in the US, sell them here, sell them abroad. And you're taking all this investment and it's going into the most productive things it possibly can, the highest multiplier things it possibly can, which closes the output gap, which allows you to have growth that's not anywhere near as inflationary as like when you say, I don't know, borrow trillions of dollars and spend it on government programs. So the whole United States economy is changing. It's changing for the better, and it's changing historically fast and like at historic levels.
And that sounds like a positive picture on many levels. But if you're talking about AI and robotics helping the US become more competitive on the global stage, again, what does that mean for the people that have been doing those jobs? And would those people not now become more dependent on government subsidies? And would that not mean more government spending, which is what we want to avoid, and maybe inflation on some products, but disinflation on other products?
So, look, David Sachs was out pushing papers in the last couple of weeks saying like, look, it's going to lead AI is going to lead to job gains. And so every historical technology shift like this has led to more jobs and higher paying jobs. Okay. Maybe the change, like, and then Alex Karp is basically saying the same thing too. Alex Karp's the CEO of Palantir. He's one of the smartest people in the world. Okay. Those guys could be talking their own book. And my pushback to them is maybe the rate of change here is just too fast so that we're going to see some disruptions. Okay. But on the other side of that, you have to believe that there's opportunities for people, and they're unbelievable opportunities. And that kind of goes to the immigration, which is why we're going to have the shutdown. And like, I'm an advocate and like, I'm a nobody, but like I talk to people that talk to Trump, and I say like, we need an immigration moratorium in this country for skilled workers, for people on student visas, until we can figure this out. Because if we're wrong and we end up with this labor shortage, you can reverse those on a dime and there's lines out the door. But look, yes, I'm people much smarter than me are saying the opposite, but I'm kind of with you that this may lead to some disruption for the workforce, and definitely lower white collar. And like our graduates, there's like a 49% underemployment rate, which means people have jobs, but not anywhere near their skill level or the jobs they want.
Again, not necessarily my position. I just like to put it as a counter theory. I will say this, that you're saying that there's a boom and excess energy and mass grid capacity and electrification That is very bullish for silver because you're going to need silver for all of this electrification on the industrial side. But beyond that silver argument, help me reconcile something that seems contradictory to a lot of people. You have gold and silver at record highs. Granted, I just gave the case for silver on the industrial side. But when you have gold at record highs, you have people talking about fiscal stress and US collapse and de-dollarization. And yet at the same time, to be fair, we do have a booming economy. We do have strong earnings. We do have a market that's risen. Granted, you could say that the purchasing power of the dollar that ultimately is behind all those equities has declined, but the economy on the GDP numbers is booming. The earnings are strong. The stock market is doing well. And yet you have gold doing so well, which is usually an indicator of stress. So how can all of those things be true at the same time? What's your theory on this reality that we find ourselves in?
Look, 2009 and 2010 were excellent years for gold, and they were excellent years for stocks, right? And I think gold is on its own island and moves in in accordance with its long-term cycles, right? Silver, there's this underlying demand. Okay. The biggest, I think the larger theory is that when commodity prices rally dramatically, it can cause a recession because the costs are too great. It makes things unprofitable, leading to a slowdown. The price of energy is not going up, right? I think they're committed to keep the price of a barrel of oil somewhere in the 50s and 60s, maybe a little bit older. Natural gas, and I think if oil were to get back up to $80 a barrel, it'd be met with such a wall of supply that you'd keep that price coming down. So if the main commodities and all the energy don't rally, like if you remember famously in the summer of 2008, I think oil went to like $150 a barrel. And like at that time I was working at Morgan Stanley, one of my buddies made the firm a couple $100 million. Thank you for keeping us afloat. We're not going to see that now. Like we're just not going to see that now with energy. And so, yeah, there's probably going to be log jams, but you're using a lot of silver now, but that's not to say that somebody won't think of something a year from now or 2 years from now to debate the price or an alternative. And all these things are happening very, they're happening fluidly, but
you're bullish on, you're largely very, very bullish on the stock market, on the equity market.
Oh, like I've never been more bullish on stocks than I am right now, particularly tech stock, particularly this AI trade. If you look at the inputs as to what drives the demand for data centers, for NVIDIA GPUs, for Broadcom GPUs, for ChatGPT, it's data. So the amount of data we create and collect right every 2 days now is the same amount of data that was created and collected from the beginning of the history of time until the end of the year 2003. That's growing every year on an exponential level. So the inputs for all these data sets are getting more complicated. All these models are getting more complicated. The use of these is getting more complicated. And once you go from the era of the large language model to the agent and application, and the agent and application is where the real value is going to come in from artificial intelligence. Okay, they use, and the AI in terms of compute, it's measured in a token basis, not token with cryptocurrency, but tokens is 3/4 of a page of a large language model. So the token demand is already increasing on an exponential basis, and it's expected to have like a 97 or 98% compounded annual growth rate every year for the next 5 years. And I'm telling you, it's likely those numbers are low. And so to build out that infrastructure, it's going to take a massive investment. There are unbelievable companies that are going to profit from that. And like you have street expectations that are nowhere near in line with reality. So like NVIDIA's estimates, NVIDIA's guiding to $500 billion in revenue over the next 4 quarters. The street's at 350 billion. Like it's, and even if they miss at 500 billion, they come in far less, and they're conservative to like they're just beat where the street is. They're still trading at 14 times 2027 earnings. Like this is insane. There's never been anything like this to happen in our history. It's so much bigger than I think even the wildest bulls understand the applications for it and everything that's coming involved. And so for an investor, if you look what assets, like, yes, gold's been doing well, but like, you have Microsoft, Meta, and Nvidia are all trading below the S&P 500's price to earnings multiple on a forward basis, which is insane because they're all going to grow in the mid 20s, if not in the 30% range. As far as the eye can see, they have pristine balance sheets. And look, these are layups. Like, these are layups, and it's these large companies that drive the indices. So I just norm again, and I think a lot of the skepticism comes. People look at how much and how far stocks have moved, and that's kind of my skepticism with silver and gold. But I can see the earnings with the stocks. Does that make sense? Like, I can see where this is going.
So you're saying that even with this tremendous rise that we've seen in certain stocks, like Nvidia, where people are saying the bubble is here, the bubble is here, you're saying that the earnings estimates are too conservative the way the market is looking at them.
It's laughable. And
And
so
and
here's
you base this on this, and that the point you made on data is very interesting when you think about that, how much the data is exponentially growing. I mean, I do get that. But talk me through why you think that the earnings estimates are too conservative.
just the gap between management guidance and Wall Street estimates. It's that simple. And if you look at the trends over like the last 3 or 4 years, and you go back, like the people calling it a bubble were the people that said the iPhone would never overtake the BlackBerry. Those out there saying that we're in some sort of AI bubble have missed every major technology trend for the last 20 years. All right. They haven't been ahead of any of these stocks. They've never gotten any of this right. Okay. And like, my favorite one to point out to people is a company called CoreWeave. So everyone's talking about CoreWeave, and they're borrowing, taking out new debt to pay an interest on old debt. Nonsense. They built a data center for Meta. Okay. They got 5-year financing from Blackstone, pretty sophisticated investor there. Okay. And the terms were 250 basis points over SOFR. Okay. Which is investment grade for a company that's quote unquote not investment grade and super levered up. Okay. And Meta pays in $1. Okay. Out of that dollar, it pays all the expenses for the data center. It amortizes the loan over 5 years. So at the end of 5 years, CoreWeave will own the entire data center, all the GPUs inside of it, which again, Meta signed a 5-year lease on the GPUs. So, what you call it, Jim Chanos, who's out of business, literally out of business. And then Michael Burry, again, returned outside capital. These are guys who are literally, they've done such a good job of investing. They've gone out of business, are out here shouting from the mountaintop, we're in a bubble, pay attention to me. I was right 20 years ago. Like, it's just, like, you don't know what you're talking about. You do not see this avalanche of demand that's coming from like, and on the other side of it, you have Blackstone, whose stock's getting beat up. Like, these are the most sophisticated investors in the world competing against people that have gone out of business. Like Jim Chanos out there talking about the bubble and blah, blah, blah. Like, he's literally returned investor capital because he couldn't make money. So I'm sorry, like, maybe he's a smart guy, maybe he isn't, but like, that's not my bellwether, right? And so,
Well,
a big, go ahead.
well, yeah, CoreWeave is up already 145% year over year. But if your call is correct, there's a lot more upside, if I'm understanding you correctly. Mike,
And it's not just CoreWeave. It's Oracle, it's Microsoft, it's Meta, it's Google. So we talk about the Mag 7.
that was going to be my next question. What are your top equity picks then, given you're so bullish?
Okay. So Broadcom, AVGO. Okay, so right now NVIDIA makes a GPU, and a GPU, what's different between the CPU is it can handle so many processes simultaneously. Okay, Broadcom is designing something for Google called a TPU, a tensor processing unit, which has a limited use, and it's specifically for the large language models. Your Grok run by xAI, your ChatGPT, OpenAI, Anthropic run by Claude, that runs Claude. Okay, so Google wants to host them on their cloud and charge a fee to do it, and they want Broadcom to built a special chip called a TPU. So the TPU, it uses much less energy than a traditional GPU, so making it's cheaper to buy, easier to maintain because it's got a limited use. Broadcom's designing them for these. It's not at all reflecting their stock. Stock's off like almost $100 from its recent high. There's a golden opportunity to go in and buy a stock right there. I think Oracle is completely misunderstood. So, like we were talking about, it's about getting data into your chat GPT and getting the answer out the other side. Oracle is the largest database manager in the world. Okay, they're going to charge you an arm and a leg to get your data into ChatGPT. They're going to charge ChatGPT an arm and a leg to host those processes. And when it comes out the other side, they're going to charge you an arm and a leg to do something with it. Okay, they are the best positioned company out there to handle this. And you have people like Morgan Stanley taking their price target from 350 down to 220 because they simply don't understand the business model and how it's going to work, right? They're assuming all the low sides of all their cash flow, and they're not going to get these rental rates where people are out there paying for it now, and like you don't really have the adoption. And just again, as a primer 101, every major entity is going to have their data. On top of that is going to sit a large language model, whether that be XAI, ChatGPT, or Claude, okay, or Google's Gemini or Facebook's Llama. But they're all gonna, and all your data is gonna feed in there. And so instead of searching ChatGPT and getting some nonsense from Reddit or Wikipedia, it's gonna be your internal data. It's gonna be really good stuff that goes in and really good stuff that comes out for you. Okay, that's where all these companies are gonna make their money. You really haven't seen anyone scratching the surface. And then when that data comes out, it's gonna be fed into agents, which are gonna do amazing things. And that's kind of how this AI stack is gonna work. And the number of people that really understand that is so limited. It's shocking that like a meathead rugby player like me knows this and most people don't.
A meathead rugby player. Well, I'll take a controversial position and I'll say that rugby trumps football and see what kind of viewer pushback I'll get on that one. But okay, I was going to ask you a point of highest conviction, but I think you really articulated it, but I'll let you consolidate it in one sentence. But just to recap, Broadcom, Oracle, and CoreWeave are some of your top equity plays here.
Yes, and then Palantir is the single greatest software company ever created. What they do is they organize data. So they're going to organize the data to feed it in the LLM. And then when it comes out the other side, they're going to push it into your business units. The glue that holds this entire AI process together.
All right. So final thoughts here, Mike.
Bullish as bullish can be. If you have huge profits in some of these metals, take some off the table. A lot more, I think more room to run for gold. We'll see what happens with silver.
All right, Mike Lee, thank you so much. Always a pleasure chatting with you. We'll have you on again back soon. Thank you so much.
Thank you, Michelle.
And as always, thank you for watching. If you enjoy our content, find it informative, which we really hope you do, please share it. Please subscribe. We also have a weekly newsletter that you don't want to miss with previews and specials and market insights. And there is a link in the description. It's also on our website, milesfranklin.com. As always, leave us your comments. Feel free to praise, whine, or just opine. We read them, we love getting them, and we often get some question and topic ideas from them. So please leave your feedback. Until next time, we'll see you soon. Stay sovereign.
This is The Real Story with Michelle Makori.